Things you need to know about recurring revenue loans before you sign up. Call 888-653-0124 today or click the link in the description to learn more. Are you thinking about signing up for a recurring revenue loan? Before you do, there are some things you need to know. A recurring revenue loan is a type of financing where you pay back the lender a certain amount of money each month. These loans are usually used by businesses who want to increase their cash flow quickly. But they come with risks. Here's what you should know before signing up for a recurring income loan. What is a recurring revenue loan? The most common types of recurring revenue loans include SBA loans, merchant cash advances, and factoring. These three methods of lending are all similar in that they allow businesses to borrow money against future income streams. They differ in terms of the collateral required, the length of the repayment period, and the rate of interest charged. Factoring companies will typically offer financing based on the volume of business being generated by the company. Your revenue stream must be steady enough for them to give you a favorable loan deal. Future revenue can also work as collateral for a loan. Here, your company will have to provide the lender with regular financial statements showing how much money it generates every month. The lender will then use these figures to determine whether to extend you a loan. How do larger recurring revenue loans differ from smaller ones? The most important feature of a recurring revenue loan is that it provides a way for a business owner to raise money without having to wait for investors to approve a loan. In addition, many lenders offer flexible repayment terms that allow borrowers to repay their loan earlier than expected. Finally, some lenders provide additional services like tax preparation or accounting help to help borrowers manage their finances better. Monthly revenue is also a factor when determining the size of a recurring revenue loan. If your company only has one source of income, lenders may refuse to lend you any money at all. But if you generate multiple sources of income, lenders may be more willing to provide you with a larger line of credit. They often give software companies large amounts of money because they make consistent revenues from software subscriptions. However, other industries require smaller amounts of money because they don't make consistent profits. Recurring revenue loans are often offered in two different ways. One option is called a revolving line of credit. With this type of loan, you can draw down the entire amount available at once. The second option is called a term loan. With this type of arrangement, you only get the money you need when you need it. You can also ask your banker for advice. They will tell you which type of loan would be best suited for your needs. Financial due diligence. The financial industry has become increasingly regulated since 2008, but many companies still cannot meet basic requirements. In fact, some banks will not lend money to new clients unless they undergo a due diligence process. Due diligence looks at the company's finances, management team, business plan, and operations. It may also include a credit check and reference checks on key employees. The subscription model is becoming popular among startups because it requires less upfront investment. However, it comes with risks. Revenue-based financing is a great way for a startup to gain access to funds. But there are several things you should keep in mind before signing a contract. First, make sure that your company is profitable and generating sufficient cash flow. Second, review your current banking relationships. If you have poor relationships with your bank, consider opening accounts elsewhere. Third, find out what kind of service providers are included in the package. Are they reputable contractors? Or are they just middlemen who add unnecessary costs? Call 888-653-0124 today or click the link in the description to learn more. Minimum $15K/mo revenue.